Circumstances we now face, whether RAF participation in airstrikes on the densely populated town of Raqqa makes sense, because I have seen no evidence to suggest that there are ground forces there that are capable or which intend to be able to take back that town. And I'm afraid that there's no time. We do need to let others get in. So that's not what these airstrikes are about. We've been told what they're about is about degrading Daesh capabilities, communications and so on. An important objective, certainly. But we've also been told that that does not mean a generalised bombing campaign and the use by the RAF of sophisticated weapons to minimise civilian casualties. So I've asked the Prime Minister to give more information about the rules of engagement involved. I've yet to receive a reply. But I am prepared to believe that the RAF will target its strikes very closely on military targets. The point is that it is not simply RAF planes that will be hitting Raqqa. It is already being bombed, and as far as I can tell, with a lot less selectivity than it was being suggested that the RAF would use. A reporter in Raqqa recently, I read an article from him that said there's been a massive escalation since November the 14th, civilian casualties dramatically on the rise and proportionally Daesh casualties going down. Like it or not, we will be seen as part of that general coalition activity, and we have to ask ourselves whether that will increase down the line, indigenous forces joining us, or decrease it. Will it build support for Daesh, or will it reduce it? And I think the risk is very, very real that we will be handing Daesh on a plate a propaganda victory, and we will allow impressionable people to be won towards their murderous brand of jihadism. So in the absence of evidence that these airstrikes will achieve their military objective, in the absence of further evidence about what that objective is, I have concluded that I should not vote today for direct UK participation in those strikes from Raqqa in this House.
Dr. Daniel Poulter.
Thank you, Mr. Speaker, and it's a pleasure to follow on from the member for Birmingham Northfield, who made some thoughtful remarks. I have come to a different conclusion about the direction which I'm going to vote this evening to the honourable member. But it's worth reflecting, Mr. Speaker, that no MP, no government takes decisions about committing UK forces into combat lightly. The debate that we have this evening has highlighted that there are no easy answers, no easy solutions to what are very complex questions raised by the conflict in Syria and the fight with Daesh. But in broad terms, there are three issues that we're considering this evening in debate. First of all, the issue of combating extremism at home and the impact that airstrikes may have upon that. Secondly, is it right to engage in airstrikes against Daesh, given concerns over our ability to engage in ground combat in an effective and coordinated manner, or support those troops that are in Syria? I believe yes, and I'll come back to that later. And thirdly, the issue about protecting civilians and refugees. So briefly on all of those
Can I have your attention, please? Give the introduction. I just want to acknowledge a few other people that have joined us since I spoke before. The ambassador of Liechtenstein, Claudia Fritsche, is here, which is, where is she? Okay. And the ambassador of India, Arun Singh, is here. And the ambassador of the Royal Netherlands, Henne Skuyuwer, is here. And the president of the Richmond Reserve Bank, Jeff Lacker, is here. Okay, thank you. So, as I mentioned, we're very honored to have the 15th chairman of the Federal Reserve Board of Governors as our special guest today. She's had a very distinguished career in academic life and in government. Let me briefly give you some of her background. She's a native of Brooklyn, went to Fort Hamilton High School in Brooklyn, graduated near the top of her class, went to Brown University, graduated summa cum laude in economics, got a PhD at Yale in 1971, where her thesis advisor was a Nobel Prize-winning James Tobin. She then went to teach at Harvard in the economics department from 71 to 76, and then came down to Washington to work in the Federal Reserve Bank from 78 to 79 as an economist. Then went over to the London School of Economics to teach there for 2 years, and then was recruited to go to Berkeley, the Haas School, University of California, and she became an economics professor there and also taught at the Haas School. She was recruited back during the Clinton administration to be a member of the Federal Reserve Board, and she served as a member for several years, and then was recruited to be the latter part of the Clinton administration as chairman of the Council of Economic Advisors. She then went back to Berkeley, taught there for a number of years, and then was selected to serve as the president of the San Francisco Federal Reserve Bank, and she did that for about 5.5 years, and then was recruited to come back to Washington to serve as vice chairman of the Board of Governors of the Federal Reserve. And then in February of last year, she was confirmed as the 15th chairman of the Federal Reserve Board of Governors. We're very honored to have Janet Yellen as our special guest, and she'll make some presentations, and then we'll have some questions. So now it's my honor to introduce Janet Yellen. Thank you.
Thank you, David. And thank you to the Economic Club of Washington for inviting me to speak to you today. I'd like to offer my assessment of the U.S. economy nearly 6.5 years after the beginning of the current economic expansion and my view of the economic outlook. I'll describe the progress the economy has made toward the Federal Open Market Committee's goals of maximum employment and stable prices, and what the current situation and the outlook imply for how monetary policy is likely to evolve to best foster the attainment of those objectives. The U.S. economy has recovered substantially since the Great Recession. The unemployment rate, which peaked at 10% in October 2009, declined to 5% in October of this year. At that level, the unemployment rate is near the median of FOMC participants' most recent estimates of its longer-run normal level. The economy has created about 13 million jobs since the low point for employment in early 2010, and total non-farm payrolls are now almost 4.5 million higher than just prior to the recession. Most recently, after a couple of months of relatively modest payroll gains, employers added an estimated 271,000 jobs in October. This increase brought the average monthly gain since June to about 195,000, close to the monthly pace of around 210,000 in the first half of the year, and still sufficient to be consistent with continued improvement in the labor market. Despite these substantial gains, we cannot yet, in my judgment, declare that the labor market has reached full employment. Let me describe the basis for this view. To begin with, I believe that a significant number of individuals now classified as out of the labor force would find and accept jobs in an even stronger labor market. To be classified as unemployed, working-age people must report that they have actively sought work within the past 4 weeks. Most of those not seeking work are appropriately not counted as unemployed. These would include most retirees, teenagers and young adults in school, and those staying home to care for children and other dependent family members. Even in a stronger labor market, it's likely that many of these individuals would choose not to work. But some who are counted as out of the labor force might be induced to seek work if the likelihood of finding a job rose or if the expected pay was higher. Examples here include people who had become too discouraged to search for work when the prospects for employment were poor, and some who retired when their previous jobs ended. In October, almost 2 million individuals classified as outside the labor force because they had not searched for work in the previous 4 weeks reported that they wanted and were available for work. This is a considerable number of people, and some of them undoubtedly would be drawn back into the workforce as the labor market continues to strengthen. Likewise, some of those who report they don't want to work now could change their minds in a stronger job market. Another margin of labor market slack not reflected in the unemployment rate consists of individuals who report that they are working part-time but would prefer a full-time job and cannot find one. Those classified as part-time for economic reasons. The share of such workers jumped from 3% of total employment prior to the Great Recession to around 6.5% by 2010. Since then, however, the share of these part-time workers has fallen considerably. It's now less than 4% of those employed. While this decline represents considerable progress, particularly given secular trends that may over time have increased the prevalence of part-time employment, I think some room remains for the hours of these workers to increase as the labor market improves further. The pace of increases in labor compensation provides another possible indicator, albeit an imperfect one, of the degree of labor market slack. Until recently, labor compensation had grown only modestly, at average annual rates of around 2 to 2.5%. More recently, however, we have seen a welcome pickup in the growth rate of average hourly earnings for all employees and compensation per hour in the business sector. While it's too soon to conclude whether these more rapid rates of increase will continue, a sustained pickup would likely signal a diminution of labor market slack. Turning to overall economic activity, U.S. economic output, as measured by inflation-adjusted gross domestic product, or real GDP, has increased at a moderate pace on balance during the expansion. Over the first 3 quarters of this year, real GDP is currently estimated to have advanced at an annual rate of 2.25%. That's close to its average pace over the previous 5 years. Many economic forecasters expect growth roughly along these same lines in the 4th quarter. Growth this year has been held down by weak net exports, which have subtracted more than a 0.5 percentage point on average from the annual rate of real GDP growth over the past 3 quarters. Foreign economic growth has slowed, damping increases in U.S. exports, and the U.S. dollar has appreciated substantially since the middle of the year, making our exports more expensive and imported goods cheaper. By contrast, total real private domestic final purchases, which includes housing spending, business fixed investment, and residential investment, and currently represents about 85% of aggregate spending, has increased at an annual rate of 3% this year. That's significantly faster than real GDP. Household spending growth has been particularly solid in 2015, with purchases of new motor vehicles especially strong. Job growth has bolstered household income, and lower energy prices have left consumers with more to spend on other goods and services. These same factors likely have contributed to consumer confidence that's more upbeat this year than last year. Increases in home values and stock market prices in recent years, along with reductions in debt, have pushed up the net worth of households, which also supports consumer spending. Finally, interest rates for borrowers remain low, due in part to the FOMC's accommodative monetary policy, and these low rates appear to have been especially relevant for consumers considering the purchase of durable goods. Other components of private domestic final purchases, including residential and business investment, have also advanced this year. The same factors supporting consumer spending have supported further gains in the housing sector. Indeed, gains in real residential investment spending have been faster so far in 2015 than last year, although the level of new residential construction still remains fairly low. And outside of the drilling and mining sector, where lower oil prices have led to substantial cuts in outlays for new structures, business investment spending has posted moderate gains. On balance, the moderate average pace of real GDP growth so far this year and over the entire economic expansion has been sufficient to help move the labor market closer to the FOMC's goal of maximum employment. However, less progress has been made on the second leg of our dual mandate, price stability, as inflation continues to run below the FOMC's longer-run objective of 2%. Overall, consumer price inflation, as measured by the change in the price index for personal consumption expenditures, was only rose only 0.25% over the 12 months ending in October. However, this number largely reflects the sharp fall in crude oil prices since the summer of 2014 that in turn has pushed down retail prices for gasoline and other consumer energy products. Because food and energy prices are volatile, it's often helpful to look at inflation excluding these two categories, what's known as core inflation, which is typically a better indicator of future overall inflation than recent readings of headline inflation. But core inflation, which ran at 1.25% over the 12 months ending in October, is also well below our 2% objective, partly reflecting the appreciation of the US dollar. The stronger dollar has pushed down the prices of imported goods, placing temporary downward pressure on core inflation. The plunge in crude oil prices may also have had some small indirect effects in holding down the prices of non-energy items in core inflation, as producers passed on to their customers some of the reductions in their energy-related costs. Taking account of these effects, which may be holding down core inflation by around 0.25 to 0.5 percentage point, it appears that the underlying rate of inflation in the United States has been running in the vicinity of 1.5 to 1.75%. So let me now turn to where I see the economy is likely heading over the next several years. To summarize, I anticipate continued economic growth at a moderate pace, that will be sufficient to generate additional increases in employment, further reductions in the remaining margins of labor market slack, and a rise in inflation to our 2% objective. I expect that the fundamental factors supporting domestic spending that I enumerated will continue to do so, while the drag from some of the factors that have been weighing on economic growth should begin to lessen next year. Although the economic outlook, as always, is uncertain, I currently see the risk to the outlook for economic activity in the labor market as very close to balanced. Turning to the factors that have been holding down growth, as I already noted, the higher foreign exchange value of the dollar, as well as weak growth in some foreign economies, has restrained the demand for U.S. exports over the past year. In addition, lower crude oil prices have reduced activity in the domestic oil sector. I anticipate that the drag on U.S. economic growth from these factors will diminish in the next couple of years as the global economy improves and the adjustment to prior declines in oil prices is completed. Although developments in foreign economies still pose risks to U.S. economic growth that we're monitoring, these downside risks from abroad have lessened since late last summer. Among emerging market economies, recent data support the view that the slowdown in the Chinese economy, which has received considerable attention, will likely continue to be modest and gradual. China has taken actions to stimulate its economy this year and could do more if necessary. A number of other emerging market economies have eased monetary and fiscal policy this year, and economic activity in these economies has improved of late. Accommodative monetary policy is also supporting economic growth in the advanced economies. A pickup in demand in many advanced economies and a stabilization in commodity prices should in turn boost the growth prospects of emerging market economies. A final positive development for the outlook that I will mention relates to fiscal policy. This year, the effect of federal fiscal policy on real GDP growth has been roughly neutral. In contrast to earlier years, in which the expiration of stimulus programs and fiscal policy actions to reduce the federal budget deficit created significant drags on growth. Also, the budget situation for many state and local governments has improved as the economic expansion has increased the revenues of these governments, allowing them to increase their hiring and spending after a number of years of cuts in the wake of the Great Recession. Looking ahead, I anticipate the total real government purchases of goods and services should have a modest positive effect on economic growth over the next few years. Regarding U.S. inflation, I anticipate that the drag from the large decline in prices for crude oil and imports over the past year and a half will diminish next year. With less downward pressure on inflation from these factors and some upward pressure from a further tightening in U.S. labor and product markets, I expect inflation to move up to the FOMC's 2% objective over the next few years. Of course, inflation expectations play an important role in the inflation process, and my forecast of a return to our 2% objective over the medium term relies on a judgment that longer-term inflation expectations remain reasonably well anchored. In this regard, recent measures from the Survey of Professional Forecasters, the Blue Chip Economic Indicators, and the Survey of Primary Dealers have continued to be generally stable. The measure of longer-term inflation expectations from the University of Michigan Survey of Consumers, in contrast, has lately edged below its typical range in recent years. But this measure often seems to respond modestly, though temporarily, to large changes in actual inflation, and the very low readings on headline inflation over the past year may explain some of the recent decline in the Michigan measure. Market-based measures of inflation compensation have moved up some in recent weeks after declining to historically low levels earlier in the fall. While the low level of these measures appears to reflect, at least in part, changes in risk and liquidity premiums, we will continue to monitor this development closely. Convincing evidence that longer-term inflation expectations have moved lower would be a concern, because declines in consumer and business expectations about inflation could put downward pressure on actual inflation, making the attainment of our 2% inflation goal more difficult. Let me now turn to the implications of the economic outlook for monetary policy. Reflecting progress toward the committee's objectives, many FOMC participants indicated in September that they anticipated, in light of their economic forecasts at the time, that it the FOMC reaffirmed its judgment that it would be appropriate to increase the target range for the federal funds rate when we had seen some further improvement in the labor market and were reasonably confident that inflation would move back to the committee's 2% objective over the medium term. That initial rate increase would reflect the committee's judgment based on a range of indicators that the economy would continue to grow at a pace served to bolster my confidence in a return of inflation to 2% as the disinflationary effects of declines in energy and import prices wane. Committee participants recognize that the future course of the economy is uncertain, and we take account of both the upside and downside risks around our projections when judging the appropriate stance of monetary policy. In particular, recent monetary policy decisions have reflected our recognition that with the federal funds rate near zero, we can respond more readily to upside surprises to inflation, economic growth, and employment than to downside shocks. This asymmetry suggests that it's appropriate to be more cautious in raising our target for the federal funds rate than would be the case if short-term nominal interest rates were appreciably above zero. Reflecting these concerns, we have maintained our current policy stance even as the labor market has improved appreciably. However, we must also take into account the well-documented lags in the effect of monetary policy. Were the FOMC to delay the start of policy normalization for too long, we would likely end up having to tighten policy relatively abruptly to keep the economy from significantly overshooting both of our goals. Such an abrupt tightening would risk disrupting financial markets and perhaps even inadvertently push the economy into recession. Moreover, holding the federal funds rate at its current level for too long could also encourage excessive risk-taking and thus undermine financial stability. On balance, economic and financial information received since our October meeting has been consistent with our expectations of continued improvement in the labor market. And as I've noted, continuing improvement in the labor market helps strengthen confidence that inflation will move back to our 2% objective over the medium term. That said, between today and the next FOMC meeting, we will receive additional data that bear on the economic outlook. These data include a range of indicators regarding the labor market, inflation, and economic activity. When my colleagues and I meet, we will assess all of the available data and their implications for the economic outlook in making our policy decision. As you know, there has been considerable focus on the first increase in the federal funds rate after nearly 7 years in which that rate has been at its effective lower bound. We've tried to be as clear as possible about the considerations that will affect that decision. Of course, even after the initial increase in the federal funds rate, monetary policy will remain accommodative. And it bears emphasizing that what matters for the economic outlook are the public's expectations concerning the path of the federal funds rate over time. It is those expectations that affect financial conditions and thereby influence spending and investment decisions. In this regard, the committee anticipates that even after employment and inflation are near mandate consistent levels, economic conditions may, for some time, warrant keeping the target federal funds rate below levels the committee views as normal in the longer run. This expectation is consistent with an implicit assessment that the neutral nominal federal funds rate, defined as the value of the federal funds rate that would be neither expansionary nor contractionary if the economy were operating near its potential, that rate is currently low by historical standards and is likely to rise only gradually over time. One indication that the neutral funds rate is unusually low is that U.S. economic growth has been quite modest in recent years, despite the very low level of the federal funds rate and the Federal Reserve's very large holdings of longer-term securities. Had the neutral rate been running closer to the levels that are thought to have prevailed prior to the financial crisis, current monetary policy settings would have been expected to foster a very rapid economic expansion, with inflation likely rising significantly above our 2% objective. Empirical support for the judgment that the neutral federal funds rate is low comes from both academic research and Federal Reserve staff analysis. This figure employs 4 macroeconomic models used by Federal Reserve staff to estimate the natural real rate of interest, which is a concept closely related to the neutral rate. The measures of the natural rate shown in this figure represent the real or inflation-adjusted short-term interest rate that would prevail in the absence of frictions that slows the adjustment of wages and prices to changes in the economy. Under a variety of assumptions, this interest rate has been shown to promote full employment. The shaded band represents the range of the estimates of the natural real rate at each point in time. This analysis suggests that the natural real rate fell sharply with the onset of the crisis and is recovered only partially. These findings are broadly consistent with those reported in a recent paper by Thomas Laubach and John Williams, which is shown in this figure. The marked decline in the neutral federal funds rate after the crisis may be partially attributable to a range of persistent economic headwinds that have weighed on aggregate demand. These headwinds have included tighter underwriting standards and limited access to credit for some borrowers, deleveraging by many households to reduce debt burdens, contractionary fiscal policy at all levels of government, weak growth abroad coupled with a significant appreciation of the dollar, slower productivity and labor force growth, and elevated uncertainty about the economic outlook. As the restraint from these headwinds further abates, I anticipate that the neutral federal funds rate will gradually move higher over time. Indeed, in September, most FOMC participants projected that in the long run, the nominal federal funds rate